call to order the Watertown Local Development Corporation Board of Directors meeting on Wednesday, March 19th, 2025. I'm sorry, Joy, did you get a chance to turn the...
It's
Okay, sorry about that.
in the middle of your good morning.
I guess we will begin with an approval of the minutes from February 19th. I hope everybody's had a chance to look them over.
Make a motion to accept them as presented.
A second.
Second.
Any further discussion? All in favor?
Aye.
Thank you very much. Moving on to the financial report.
See our balance sheet for February, end of February 2025. We show our loan receivables at just under $6 million. We've got investment assets of $4.1 million. Given us, in our cash position in the banks at $158,000, giving us total assets of $10,305,000. We have one small liability, which is our lease year, our long-term lease, for $273,000, giving us total liabilities and equity of $10,305,000 from the balance sheet matches. Our income for the month of February predominantly generated from investment activity of $18,500. We did receive interest on loans of $14,006, giving us a couple other smaller items in recovery debt and loan fees, giving us total income for the month of $35,000, just short of $36,000. Expenses for the month are listed there, totaling $18,000, giving us a net operating income for the month of $17,000. Kind of looking at an annual basis, our total income through February, all activities was $113,768. Our expenses for the first 2 months totaled $55,291, giving us net income year to date of $58,477.
Okay, can I get a motion to accept the financial statements? Okay, so moved. Do I have a second? Second. Any further discussion? All in favor?
Aye.
Any opposed? Okay, February customer loan report.
So going to the customer loan report, we have an updated one that I handed out this morning. But number 4, again, is still staying about 60 days. But his balance is now $1,060.75. I did not update that on there. 37, she is current as of for February. We just received her payment on the 18th. Sandgate, so 56 is going on 2 months past due. 63, I just spoke to him this morning. He is bringing it current in the next couple days. He is current for February, he's working on March's payment. And then 68 is still past due. Every time I speak to her, it's that she's trying. So I definitely think in our next loan review committee meeting, we'll have to talk about that. Any questions?
Okay. Can I get a motion to accept the February customer loan report? Second.
I'll second.
Any further discussion? All in favor?
Aye.
We should probably go on to the auditors.
Okay.
Is the next, we'll go out of order.
Okay, all
If you
right.
don't mind.
That sounds great. We will move down to the Bowers and Company on the new business audit and financial statements. And I want to welcome the fine folks from Bowers that we've been working with for many years.
Thank you. You know everyone in the room here. I'm Liz Bush from Bowers, audit partner, and this is Lindy Hill, the audit manager. And we're here today to present the financial statements. So You've all had a chance to look over the copies that were provided, and we'll go through them. And if you have any questions, feel free to stop me along the way, or we can take questions at the end. If you turn to the independent auditor's report, that's immediately following the table of contents. Here, we issue an opinion on the financial statements. We issued a clean, unmodified opinion on the financial statements. It means they're fairly presented on all material respects in accordance with generally accepted accounting principles. At the bottom of this page, you'll see the responsibilities of management for the financial statements, and management's responsible for the preparation and fair presentation of these financial statements. And also to have internal controls in place over the preparation and fair presentation of those statements to make sure that they're free of material misstatement. On the next page, we continue on the auditor's responsibility. As an auditor, we're responsible to provide reasonable assurance that these financial statements are free from material misstatement, and reasonable assurance is not absolute assurance, but it's a high level of assurance that they're fairly stated. We also conduct this audit in accordance with government auditing standards. That's required by the New York State Authority's Budget Office. And then down below on this page, we do list in bullet point fashion the items that we perform in an audit. Typically, identifying risks of material misstatement, understanding internal controls, evaluating accounting policies, and whether there are any conditions or events to determine whether or not there's a going concern issue, which there is not. And then over on the next page, on page 3, we do have to report, and again, like I just said, in accordance with government auditing standards. And you'll see a report at the end of the financial statements. Page 4, statement of financial position. This is your balance sheet for the organization. At the end of December 31, 2024, you had total assets of about $10.2 million. That's up about 5% or over $500,000 from last year at this time. Your largest item is your loan portfolio. That's at $5.7 million. That's carried with an allowance against the accounts. That did increase about $320,000 from last year. The reason that has increased is we've adjusted the allowance this year. Management spent quite a bit of time, looking at the allowance, all the factors that are involved, and you'll see that later in the notes. So we did make an adjustment based on the new CECL standard, the current expected credit loss standard that was in place last year. And again, this year management has updated that policy to include more relevant information in accordance with that standard. Also, your second largest item of assets are your investments. That consists of investments in what we refer to as temporary cash investments, which is CDs. So that's about $3.7 million. That's up a small amount, about 6 to 7% over last year. Down below under liabilities, we do carry a liability. That's for the operating lease liability. It's $273,000. That standard went into place 2 years ago, and what that is we have to record a right of use asset and liability for the lease on this building space. So that leaves you with net assets at the end of the year of about $9.9 million. That's up about 6% or over $500,000 from the previous year. Over on the next page, statement of activities. On page 5, this is your income statement. So here you had total support and revenue of $638,000. That has decreased about 30% from last year, over $270,000. The reason being for that decrease is last year there was the DRI grant in the income statement that was about almost $380,000. That grant has been completed and closed out, so we don't have a similar revenue item this year. Your investment income and your realized gains and unrealized gains and losses did increase slightly over the prior year, of about over $50,000. Down under expenses, you have total expenses of $93,000 this year. It's a significant drop from last year of $1 million. I'll be able to explain that, and you'll be able to see it more clearly on the next page. And what that is making that adjustment to the credit loss. So your change in net assets for the year were $544,000, bringing you back up to the 9.9 million in net assets. So here on page 6, this is statement of functional expenses. So this is all of your expenses detailed by the natural expense category going down the left-hand side of the page, and then you can see program services and management general across the top. So there were some changes to salaries. We did have Don retiring and Kylie, and we now have Joy. So there was just a small change in the salaries and the benefits. But one of the most significant items of change are the facade and rental assistance program. That was the DRI program. This year we did not have any grant expenses because, as I said momentarily ago, that grant was closed out. So you'll see a decrease of $365,000 in expenses there. And then further down the page, you'll see credit losses recoveries. So what that is, in the accounting world, we have to record an allowance against your receivables. And then, based on the judgment involved in that and all of the loan policy and all the factors that go into that, sometimes that increases or decreases. This year, we had a decrease in that, so you'll see a negative $253,000 compared to a positive $322,000 in the prior year. So that's a swing of over $500,000. Again, basically, just adjusting that allowance based on all the different factors that are involved. And there's notes on that, and we'll go over that in a minute. So that leaves you at the end of the year with total expenses of about $93,000. Next page, page 7, statement of cash flows. This statement brings you from the accrual basis back down to the cash basis of accounting, so you can see that fluctuation in your cash from year to year. So we started with that change in net assets of $544,000, and we're bringing all of the non-cash items out of there, that credit loss adjustment and investment, unrealized gains and losses and things of that nature. So we had cash provided by operating activities of about $81,000. And then cash provided by investing activities was about $58,000. And what that is you're issuing loans, you're receiving payments on loans, and then you're purchasing investments, selling an investment. So that's the change, that's the fluctuation in those accounts. So you had an overall increase in cash of about $140,000. The next page, page 8, is the notes to the financial statements. No significant changes on the first few pages, so if you want to turn to page 12, we are required to disclose whether there's any significant concentrations of credit risk. There were not. Your deposits and your banks are insured by the FDIC, and then also your investments have SIPC coverage at the brokerage firm. On page 14, this starts the loans receivable row. So again, here's more detail in that loans receivable, the types of loans that are issued, and then what that allowance for credit losses is. So you see loans receivable of just under $6 million, and there's an allowance of $283,000, and that brings you down to the net $5.7 million that we saw on the balance sheet. Again, a lot of work went into this year from management, concurred with us. We had a few meetings and discussed this, and then expanded on the existing loan policy and came up with a credit loss policy. So it was a lot of work, good work, and thank you. On the next page, on page 15, we have an analysis of the loans receivable, so you can see for both years, 24 and 23, you'll see the total gross amount of those loans of $5.9 million, and then you'll see the aging of them. Most of your loans are current. They're about $5.8 million are current. There are some in the 30 to 59 day range, and a small amount in the older 60 to over 90 day range. Down at the bottom of the page, the credit quality information. This is what I was referring to a few moments ago. There's different factors involved that judgments used to come up with that allowance. There is an internally assigned grade, there's satisfactory watch, and then continuing on the next page is substandard. And this is what management and the loan review committee do. They discuss this, come up with the percentages that are gonna be used for the allowance, and then put other qualitative factors in there in that calculation. So you'll see in the middle of the page on 16, most of the loans were satisfactory, about 5.7 million. There were a few in the watch category and some in the substandard. But predominantly, most of them are in the satisfactory column. And then below is the allowance for the credit loss. We have a detail here starting at the beginning of the years, and then what those changes in the provisions are in credit losses, and then it brings you back down to the balance of 283,000. On the next page, on page 17, we do have a note 4 on commitments. There were some commitments at the end of the year of to grant loans at December 31, 2024 of about 690,000. And then below that are the temporary cash investments. Those are your CDs. And at the end of the year, they were just under 1.4 million. On the next page, you'll see an investment note, note 6 on page 18. And here we disclose the fair values and costs again of your investments. The investments totaled about 2.3 million, and then again, you'll see the fair value and the cost presentation. On page 19, we do have an operating lease note, note 8. This, as I said earlier, this was the standard that went into effect about 2 years ago. And what it is, it's the lease of the office space here. So we have to, based on the new standard that was put in place, we have to calculate that right of use asset and corresponding liability. Basically, on your statement of financial position, they pretty much offset one another. And then on page 20, we do have a disclosure of the future minimum lease payments that are due over the next 5 years and thereafter. I believe with all the options on this lease, it runs through 2043. So it brings you down to less the interest that's taken out, down to the $273,000 total. On page 21, we have a liquidity note, and that's note 11 on the bottom of page 21. And what this is we're required to also disclose your liquid assets and then those that are not available for the next year to meet general expenditures. So you'll see here we'll list your cash, your investments, receivables, and then we deduct from that investments that are longer term, and then the loans receivable that are expected to be collected past 1 year. So you have about $2 million in financial assets available to meet those cash needs for general expenses, and that's well within the range of what you need to meet those expenses. And you saw that on the functional expense statement. And then the next note is a fair value note on page 22. It's just a required disclosure, for the CDs and investments. They're all either level 1 or level 2 investments. So following that, there on page 24, there's the last report in the set of financial statements. And this is the independent auditor's report on internal control and compliance in accordance with those government auditing standards. And this is not an opinion report. However, if there were significant deficiencies and material weaknesses, we would be required to disclose them in this report. Pleased to report that there were not any significant deficiencies or material weaknesses. And then following that, there's some letters at the back of the financial statements. These are usually loosely bound in a paper set of financial statements. The first report is it's due with the Paris report. What this is, it's an independent auditor's report in compliance with the public authorities law on investment. So here we would disclose here if something came to our attention that you weren't adhering to your organization's investment policy, or there was something else that we needed to disclose. And pleased to report there weren't any findings in relation to this report. Over on the next page, this is a management letter. This is where we just have some suggestions based on our audit work of things that you could consider putting into place, just enhances internal control. We did suggest, that since there's not a review and approval process in place for journal entries, that there's a process put in place where, you know, the recording of the journal entries would be done by the CFO, and then maybe the CEO or a treasurer even could approve them within that monthly set of reports that are reviewed every month. And, you know, totally optional how you want to handle that, and if you have any questions, we can assist you with the implementation of that. And then the last letter is the communication letter to the board. We're required to provide this letter. Here we have to disclose any new accounting policies that were implemented, and then all your significant estimates. You do have significant estimates in the financial statements. At the bottom of the first page, you'll see, you know, you have your estimate for those credit losses. That's a significant estimate. And then continuing down the next page, there's an estimate for depreciation, and then that lease calculation with the present value of the right of use asset and lease liability, and then the functional expense allocation, you know, how we're determining, you know, based on the information provided by management, what is program service versus administrative type expenses. We did attach the material journal entries as part of the audit, and you'll see those on page 4. And also, we didn't have any disagreements with management over the implementation of accounting policies or difficulties encountered performing the audit. Everyone was very cooperative. You know, I want to thank, you know, Kylie and Joy for always, you know, making this such a smooth process to get this done. And it's a short deadline for the local development corporations. They all need to be done by March 31. So thank you.
That is great. Thank you very much, Liz.
You're welcome.
Can I get a motion to accept the 2024 audit and financial statements report?
So moved.
Any second? Any further discussion? All in favor?
Aye.
Any opposed? Thank you very much.
Okay, thank you.
Thank you, ladies.
Thanks.
Have a great day. Okay, moving on, we
Now
will,
let me have,
yeah,
cereal.
that's what I was gonna say next. Great.
Sorry,
Yeah.
I'm used to telling him what to do, I can't help it.
Moving on, we have RBC Wealth Management, Cyril Michael here to join us for the annual investment update. Please take it away, sir.
Thank you. Good morning. Thank you for having me. And John was supposed to be here. Hopefully he will be here soon. So we're ready for next year's meeting. I came in late, but we're late for this one. I apologize. So just to go over a couple of things. Some of you have been on this board for a very long time, and some of you I see new faces. So just to go back a little bit of history, to update you a little bit on what we have done in the past, what we are doing right now, and where we think we're going from here. So historically, this was just cash. You used to only buy CDs, short-term CDs, etc. And then we got hit with the years where CDs were paying, I remember, 0.15% or 0.1%. It got ridiculous. So we came into your board, and under the, basically leadership of Don, we started, the first change was to add basically fixed income. That was a little longer. Then we got an authorization to add corporate bonds that add a little bit more in terms of interest. And you guys restricted us on the corporate bonds to have up to 25% in your investment policy aggregate in corporate bonds, and up to a maximum of $50,000 at purchase per issuer. The portfolio was always like about $5 billion or so. Last few years you've been taking some more money, which is good. It means you're loaning to the community, which is your objective anyway. But at this point, basically, we make sure that we adhere to that. And again, corporate bonds started paying almost nothing. So again, under the leadership of Don, we were able to get you to put up to 25% in equities in the portfolio, again, with never exceeding more than 1% of the portfolio value per issue, per company. So if the portfolio with us right now is about 4 million, the limit that we can have per company is roughly 40,000. So those are the parameters under which we operate, and luckily for you and for the corporations that you've done that, it helped the performance very nicely, and it was a nice enhancer without taking undue risk. In our world, when you have a portfolio that's 20-25% stock, believe it or not, that's a lower risk portfolio than 100% fixed income because of inflation, because the equities will cover you for inflation, etc. So we have been adhering very closely to that. We have monthly conversations now with Kylie, just like we did with Don, to determine what are your cash flow needs. And what we try to accomplish with this portfolio is not trading your bonds and in and out and whatever. In the 20-some years that I've been doing this for you, I don't recall having sold a single bond. So we make sure that what you need, your cash flow, we know what are the loans that you're going to distribute. And let's say you have something in June and we have $250,000 sitting. I'm not going to buy a 20-year paper with it, but I'm going to buy a treasury that will mature, say, end of May. So we get you at least 4% or whatever until the loan is due. And we have this constant communication to make sure we don't need to sell anything. So the bonds that mature will take care of that. Now, if a big loan come in and big request come in and we have to sell, no big deal. Liz mentioned to you that there was about $2 million that within like 12 months or so short term, those are very liquid. Especially T-bills, I can put the order to sell it now and get you the money in the afternoon. And usually with almost no risk or whatever, because they don't fluctuate much. So to make a long story short, our first and foremost objective always for you is to look at the investment policy. What does it allow us to do? Look at your cash flow needs, and based on that, we invest. So if you compare this portfolio, let's say, to an endowment or a foundation that's 70% stock, etc., that's not fair. That's not what we're trying to accomplish here. You guys are loaning money. It used to be 5%. I don't know if you changed that. 6 now?
Yeah.
So I mean, we're trying for the money that is not being loaned to get you as much return as we can, basically, on that, and that has always been the objective of this, and go from there. So when we look at what's happening, everything that we do in our world is back to interest rates. So whether you're buying a bond, you're buying a stock, etc., it's always interest rates that dictate what's going to happen. So, and interest rates are dictated on the short term by the Federal Reserve, which today at 2 o'clock they'll come in and say what they're going to do. Our expectation is they're going to do nothing. Because what happened, as you know, when they brought rates down after COVID to 0, it was something we've never lived before. They didn't know how to deal with it, so they flooded the market with cash. If you put money at 0%, they all go to friendly bankers and ask for as much money as they can get and do something. So this is how we reignited the economy, and it worked out very well. After that, what that did, it created inflation. So to solve the inflation problem, now you've got to get ahead of it. So they started raising rates, and they raised rates a few times. You have some people out there that say, oh, they're going to raise a little bit more, or no, now they're going to start cutting. We are of the school that we are where we need to be. And if we were the Federal Reserve, we'll be sitting on our hands for a little bit to see what's going to happen. As you all know, you all watch the news, and every 5 seconds we have something new happening. We get bombarded by information, whether it's tariffs on this country, whether it's job cuts here, whether it's some new lawsuits on I don't know who, which department. It's like mind-boggling. So our job is to, shut the noise, look at your portfolio, and like I said before, go back to cash flow needs, go back to, the investment policy, and, not worry too much about these things. We do believe, though, that if we were to give you our point of view, that rates will remain stable for a while. There is no reason right now. We don't think this economy is faltering yet. Could we get in a recession? Possible. If you start firing left and right, people will have no jobs, so they're not going to spend as much. Or if there is a fear of being fired, it can have also almost the same impact, because all of a sudden, if you think, oh, my job is not safe, maybe I should be careful with spending, maybe I'll wait on that new car or whatever we were going to buy. So that's why, perception becomes reality. So we could get in a recession, but we are not yet in a recession officially, and we could still circumvent a recession, and we could be okay from here. So, we'll see where this is going to take us. We're not in a panic mode, but we're not also, adding to portfolios like crazy. Some people tell me, oh, the market's down 10%, are you buying more? Incrementally, a little bit, yes, but we're not loading up the truck. Because things could still get worse before they get better. We watched this movie so many times, I've been doing this for quite some time. April, they're talking about phase 2 of these tariffs. What does that mean? I don't know. Is it a ploy? Is it a tactic? Or is it really gonna hit? And maybe Trump thought that the Canadians will be very agreeable and no problem, etc. Well, we have a new, prime minister there who seems to be feisty, and they're saying, just like we beat you in hockey, we're gonna also beat you in this and whatever. I mean, it's all talk right now. At the end of the day, I mean, Trump can get what he wants because we are the bigger, economy 10 times bigger, etc. And they have tariffs on us. But again, I don't know any of that stuff. For us, take it back to basics, and we go back to what your cash flow needs, etc. And go from there. So before I move into your portfolios, questions, concerns about the economy or what we're doing in general before we talk about your portfolio? So what I like to do, we'll get you the numbers for last year, they were excellent. But I feel like whenever a lot of drama is happening and changes are happening, it's nicer to look at numbers as of right now. Where are we today? So I'll get you the numbers for last year, but as of today, we are up for the year, believe it or not. With all this drama, you're up about 0.8% on the portfolio, which is pretty good, I think. And our 1 year performance, all in, once you factor everything in right now, is about 6.6%, which is not bad. Long-term performance, again, last 5 years or so we've done well, but keep in mind, it's only in the last 5 years or so that we added equities, that we added corporate bonds. Before that, it was all CDs, and for a long time, you had 0.1 and 0.2 and 2% and 1.5. So the long-term performance has been a little shy of 4%, which is not too shabby. What is interesting in this portfolio when I look at it, we look at all the money you put in over the years, we look at all the money that you took out over the years, and the portfolio is up in terms of growth and income since we started together. On a $4.1 million portfolio, $2.8 million is growth and income. So really your principal in this portfolio now is about 1.3 or so. The rest of it is all gravy, which has been phenomenal. Year to date we're up a little bit, but in the last 1 year we're up $255,000. Last 5 years we're up over $1 million. Last 10 years $1.4 million, and we'll get you all this data. So the way we are managing the money, as I referred to before, is we always look at what is the best allocation right now for what you're trying to accomplish. So currently you're about 21% in stocks. As I mentioned before, and you'll have a copy of this hopefully, where you have a copy of the investment policy for those who have not seen it. It was revised, I think, 21 last time, and it allows us up to 25%. So we do have about 4% leeway. And the reason why we're leaving this 4% is because you're going to have some money to be drawn soon. And once you do that, automatically my balancing changes. So I don't want to be forced to selling stocks if this gets worse, because we could have a rough second quarter, we could have the market go down another 10%. I mean, some people are panicking, oh, we're down 10%. In the big scheme of things, 10% is nothing. I mean, I know it sounds like a lot and whatever, but we've seen that so many times. I've seen, you've seen it, 07 to 09, the S&P 500 was down 50%. In 2000 to 2002, the NASDAQ was down 80%. Went down from 5,000 points to 1,000 points in a year and a half, and it took till 2013 to get back to even. That's why when you look at portfolios, we don't have a lot of anything. We make sure you have very little in every stock. We make sure that we have a calculated amount in every sector. So if technology was doing great last year, good for technology, but we're not going to chase it. So you own all these big names, the Apple, the Google, the Microsoft, and whatever, but we own them in small increments. If I buy the S&P 500 today, you're buying 8% in Apple, 8% in Nvidia, 8%. That's why we don't buy the S&P here. We buy the stock, and we have 1.5% possible, and less than that even with all these individual names. I don't think any of the individual names that you currently own in the portfolio show even as a 0.5% position. So we are also meeting what is in your investment objective and in your policy, basically. We also have very nice diversification in the portfolio. A lot of it is in large cap, which is the lowest risk, to own. Then you have some mid cap and some small cap. You also have some international exposure as well, which gives you a nice perspective. And why do we do that? On January 1st, if we all sat down here and raised our hands and talked about Europe or talked about China, would we have thought that Europe and China would be up 25% year to date and the US will be down 10%? Probably not. That's why we always maintain a little diversification, because you never know when these markets will recover. The US market became priced for perfection. Everything was great. The multiples that we use, which is called price-earning ratio in the US, got fairly high. To give you an idea, we got to about 22 times earnings. On average, we're about 15 historically. Europe is about 13 times earnings, and China was about 10 times earnings. So all of a sudden, there was some opportunities to go into those markets. Now, they're not as stable as us. They don't have the same growth that we do, etc. But now that we have a president that is kind of shaking things up, that means uncertainty. It might be very well long term. It might be an excellent strategy. I don't know. But Wall Street hates uncertainty. So when you have uncertainty, people have a question mark, and that's why they'll go somewhere where there seems to be more certainty into what's happening. So again, the account is very well diversified. Same thing with your fixed income. We have all the cash that you need for distributions, and we make sure that you have plenty of cash. So as of right now, in 2025, on top of the cash that is in the account, you have $850,000 maturing. Next year, you have $400,000. In 27, 300, etc. So they're all staggered, and the quality of the portfolio is very high. So I know that sometimes this will, tell you, well, there is this and that. So there are 4 pieces in this portfolio that were bought when the market was very low. What they did, we talked about them in previous meetings. They're called hybrid preferred. So they're Goldman Sachs. They're names like banks that are very solid. But what they did back then, they gave you 5%, roughly 4 to 5% for 5 years. After that, they will give you the 5-year treasury plus 3% on top of that, which is very appealing. But they were callable. So a lot of these will be called within the year, most likely. So they will disappear from your portfolio. We would have got the 4 or 5% on them. But their credit rating, because they don't have a maturity, is not the credit rating of the corporate bond. So Goldman Sachs, if you own the corporate bond and Goldman Sachs goes bankrupt, which I doubt it will, but the first people who get paid are the bondholder, the hybrid preferred will be next, and the stockholder will be last. So we have the one in the middle, so it can show that it's, they call it split rating, so instead of being, let's say, A minus, it could be double B plus or something like that. But we're not worried about them. They're very solid names, and most likely when I come next time to next meeting, hopefully I'll be on time and I'll know where I'm going, because I went to the old location today. First time I come here. So anyway, this is a beautiful office, by the way. So these will be gone from your portfolio anyway, and they represent $50,000 each times 4, so there's $200,000 on the $4 million that is in this category. They call it basically split rating. So S&P would rate it as investment grade, another rating agency will rate it below investment grade. In the past, we came to you if we needed an exception to hold them. Because of the split rating, I think we're good, unless you felt strongly about anything. We can get rid of them, but we recommend not touching any of that stuff. And it's still paying you 5%, and very, very likely we pulled the 4 of them. A lot of the others that you had got called. So there's Comerica, Fifth Third Bancorp, Goldman Sachs, and Huntington National, and they're each $50,000, and they're all callable within the next 12 months. So that's one question for the board. If there was any issue, we can sell them, but our recommendation is leave them alone. We're going to be fine. So that's in terms of the credit quality on the portfolio. Beyond that, again, we are not changing anything, depending on what you tell us. I mean, what your cash flow needs are going to be. If there are opportunities to go a little bit longer, get you a little better, we might buy small pieces here and there, but most of them will be callable. So if we get 0.5% to 1% more than buying a short-term paper, and I can get it callable 1 to 2 years, we're going longer. We're able to get now 5.75, maximum 6% on investment-grade corporate bonds callable. So that's where we're going with new money, or we're staying very short-term with treasuries, getting you the 4%, depending on what the funds are for, and go from there. So the 2 projects that we spoke about was 250 and 400, and I don't know if there's anything else that we should be planning for at this point?
At this time, no, because I know we spoke about a potential other loan, but we decided the loan was made against that one, so it's just the one, the new loan is coming out of what we have in, our checking account. So,
Perfect, perfect. Yeah, so in a nutshell, I mean, you know, we've been very happy with the way things are going, and again, last year, if you looked at your top 10 holdings, it was the Mega 7 that was, you know, this year you look at your top 10 holdings since the beginning of the year, a lot of the names you'll be surprised, it's the defensive name. The biggest contributor in your portfolio is called BAE Systems. Some of you might know it, some of you might not. That's basically European defense contractor that is getting now, you know, a huge boost because Germany is going to have to spend a gigantic amount on defense. So that is up 47% year to date. And then it's the healthcare in the US like Amgen, AbbVie, etc. that have done very well for you. So that's what's working this year. And again, we have a total diversified portfolio, about 10 to 15% in each sector. There he is. We're definitely ready for next year's meeting.
And then you texted me, no, it's this place, and we're walking around for 15 minutes out there. Sorry about that.
I told them we're ready for next year's meeting.
Yeah.
Do you mind passing those?
No. Apologies, everyone.
Yeah, no, so that's good, and you'll follow me here, and I'll just point out a couple of places that you need to look at. But beyond that, I mean, we're very happy with the way this is going, and so if you don't mind, I'm going to have you look at tab 3, page, just go to tab 3, page 4 of 15. And I'm going to go quickly over these items because I've already described them to you, but just so you know when you get a chance and you want to look at this thing. So again, this will show you on page 4 of 15 under tab 3, asset allocation, one to many. So you will see where this is basically equity 21%. That's what I was trying to show you. There's about 870,000 in equities. The rest of it is mainly fixed income and cash. So that's what you're looking at. And then the other thing I was going to show you is if we go to tab 6 of 15, the other thing I'm looking at on 6 of 15 is under the bottom part, the sector allocations. Information technology is 17%. The market right now is 29%. And we are on purpose underweight technology because they're expensive. So again, this is not an oversight or anything. It's done on purpose. Then you have the credit quality for the fixed income bonds. The two that were, you know, the 200,000 I mentioned to you is what is showing as BB+. So we discussed that. Those are the hybrid prefers that I mentioned also. That's under page 7 of 15. Page 8 of 15 will show you what is maturing and when. So that's important in terms of cash flow planning. As you can see, most of it is short-term because this is a short-term account. This is not an endowment or anything like that. And the other part that is interesting, the income under page 9 of 15 is $121,000. So that is roughly 3%. So what you're getting right now is 3% yield plus a little growth. So this is how this portfolio is set up at this point. And finally, under page 10 of 15 is that scorecard I was telling you about, which is, okay, over the years, how did we do? So the light blue line in the portfolio growth is what you have invested over time. You've added money, took money out, etc. And you can see where, what I was mentioning before, the investment in this portfolio right now is about 1.3 million. The value is about 4.1, and the delta since performance start is that 2.8 million. Which comes to about 3.88% since inception. So that's in a nutshell where we are with all of that. Now the numbers that Liz was sharing with you were for the finish of 12/31/24. And this is that extra page that is here. If you want to know, okay, what did we do last year? So last year you did excellent, and the numbers were better because of course, you had a year where you were up 8.36%. So last year you were up 315,000, which is phenomenal. And then you have the performance per year, etc., on all of this and the averages. So you have that on this sheet that tells you what things have been doing. Remember that when they raise rates, what happens to the value of your bonds? They go down. Liz talked a little bit about that. So what they do, they put a provision. I mean, we haven't sold, we haven't bought anything. But you buy a $100,000 bond, that pays 2%. And it still has like 2 years to go on it, and the new rate is 4%. So that 2% differential times 2, it will show on your statement as 96,000 instead of 100. At maturity, you still get the 100. But that's what she talks about whenever she does these changes. So we try to avoid these, but you have to show them because they call it mark to market in a fixed income portfolio. But all these gyrations at the end of the day amount to, in the long term, to zero, because we're holding it to maturity, we're not trading these bonds. So I just want to be clear that whenever they talk to you about market value adjustment, if it's good, don't get excited. If it's bad, don't get excited either, because it's going to be a wash at the end of the day. It's just an accounting figure they have to show. The only time where it matters, if you guys come in and say, well, when the market is really low and interest rate went up like crazy and you want the full 4 million, and we sell bonds at a loss, this is when you materialize a loss. But in the history of this organization, I never had you call me and say, give us $2 million, like inadvertently, just like that. You've always done calculated decisions, you've always done calculated lows, and there hasn't been surprises, at least that I'm aware of in all the years we've been working together. And anything that you know, that's why we have this monthly communication, at least to know where are you, so we match this to what you need. So again, questions, concerns, I mean, I threw a lot of information at you here. This is on the overall picture of the portfolio. Questions, concerns on that so far? Did I confuse you all enough?
Well, something that's really, I don't know if you mentioned it, we noticed you do have the investment policy at the back of your packet. Something we did notice was corporates moved up to 31%, where the limit's 30. Part of the reason for that is we've seen short-term rates come down, so the opposite, the value went up. Also, we bought a lot of pieces at what we call a discount. The same reasons that if rates go higher, the value of your bond goes down, so we've been buying some bonds at 82 cents on the dollar, but they eventually moved to par. So we've had some natural appreciation of the bonds, which kind of pushed them up. We have a few options. We do have a couple of bonds that look like they're being called in a couple months, where those will come off, those are corporates, or we could sell. So I don't know if there's a consensus among the group. This will rebalance itself naturally on its own in relatively short order. We'll get it under that, but that's just something we did want to point out, because we do keep a close look at that. We're constantly looking at that.
Well, I had a question about something you mentioned with regard to something, I think, coming to maturity, and if it does, then our percentages change, and you may have to sell, and it's not necessarily a great time to sell.
Correct.
So maybe you could explain that a little
Yeah,
bit.
yeah, so this actually
This
ties
is
up
the same
with
thing,
John.
yeah,
It's an excellent question.
Yeah.
So on the equity side, we left about 4% breathing room in the investment policy. So let's say we remove 400,000 from the portfolio. So now instead of 4.2 million or 4.1 million, we got 3.7, let's say. So my percentages now on the 3.7 million, the equities is going to be 25%. I would still meet the policy. I'm very worried about equities selling off like crazy. I am sweating the fixed income much less, because I do anticipate somewhat of a stable market in fixed income this year. Now, what John is mentioning is the same issue that we have, but on the fixed income side. And what he's saying, you're at 31%, like 1% more. I mean, it's really no big deal. But what's going to happen when, let's say you move that 400,000, now you're going to be 34%. At that point, if nothing gets called, you know, we need to sell something if we want to remain within the parameters of the policy, basically. And you know what? I mean, I don't want to go and change the policy to make that work. Because what might happen also, you might get a loan that get paid back, and you know, you add money, then we'll buy again. But I think my recommendation is, I think this policy worked out well for us. I don't know that I want to recommend you change the policy unless you guys felt strongly about anything. But I think it's nice and simple. It gives us enough leeway, and it doesn't put us in an uncomfortable situation. So my recommendation would be, when she moves the 400, if these bonds haven't been called, and now you're at 35% corporate, guess what? We'll take a few chips off the table. You know, we might take a profit on them, and I can replace them with, you know, something that's paying 5.25. Worst case, I can get 4.5 on the treasury and keep it liquid for the next payment or whatever. So we'll figure it out. Our stance right now is we're very comfortable on the equity side because we have that leeway. On the fixed income side, because we never sold bonds, like I was saying initially, anytime they needed cash, we took it from the cash that matured, basically. So at this point, we could you know, if we have to sell a little bit, I mean, keep in mind, you're taking money that's generating 5%, let's say, you're putting it to work at 6%, and that's your mission anyway, is to give loans. I mean, if you're.
But should we consider taking that 400,000?
Meeting,
Well,
It's for, the globe.
Well, we're committed on
Yeah,
that, so we
committed
have
on.
to do that. We're committed there.
So we
Those
and
are
we don't
the
have
loans.
other options to,
No, we're committed right now
No.
for 650,000
Yeah.
stuff that we will be taking from our investments to
Mhm.
fund. 'Cause
So
we
s-
don't have,
Steve, valid question, valid. But the money we're talking about today, we have to employ, right? Because we've committed to these loans already. They're on our approved list, just haven't funded yet.
but if we're at 31, again,
Yeah.
I'm not an expert in this field, but if we're at 31, can you not sell the 1% and get that 400,000 that way instead?
yeah, no problem. At this point, no problem. But depending on what you bring in, what you take out, I might end up being at 35. And then now I'm reaching your policy. 1%, I don't think anybody's gonna, you know, be too upset about. But if we put it at 35 and 36 and 37, and next year something happens in the corporate market, and you come in and say, Cyril, we trusted you with our investment policy to stay within the parameters. You went over 7%, you're not gonna be happy, I'm not gonna be happy.
No.
That's why I think we need to address it, if that's the case. But we're not there yet. I think a 1% is something that can change in one day. So I don't want us to be like, you know, to the book to 1%. But there's also common sense there. But I think if we push it to 5 and 6 and 7%,
Yeah.
then we're not doing the job you hired us to, because you gave us an investment. By the way, the investment policy, for those who are not familiar with it, is under tab 6. It's simple, it's nice, and I like it, but if one of you or some of you would like to revisit it, and if you have ideas of what needs to be changed on it, of course, you know, you can make a recommendation to yourselves to do it, and we can look at it and see if it creates any problems. But as of right now, the way it sits, we're within 1%, we're not reaching anything here, so we're really, yeah.
I guess my question was more about our action, and if we have to take this 400 to fulfill obligations, is there another way we should be looking at doing
The
that?
only thing is loan repayments. If between now and then, you guys are getting more in loan repayments, somebody paid early because they sold or whatever, then that will add cash flow to the situation. You might have to take less. But what we usually do is we like to plan for the worst, so there are no surprises. And if you guys get an influx of cash, even better.
Think of what we're talking about as the full picture of our balance sheet. We're talking specific to his investment asset today. What Cyril's trying to say is that other asset we have, that $6 million loan account
Yeah.
receivable, if somebody gives us $1 million tomorrow, that's cash in our hand at that point. We gotta be strategic about what that receivable is and understanding, when we look out at it, we don't anticipate anybody accelerating repayment on those.
Right.
We just don't. We know that customer list, we know that loan list that's supposed to do. We don't see anybody on that list that, as we sit here today, say, well, there's a $300,000 loan out there that we anticipate in the next 3 months, they're gonna sell their business and pay us back.
But what I meant, and again, this is probably a fundamental just misunderstanding on my part. If we're up 1% from what we should be, can't you, again, this is
You're saying
naivete,
sell
can't we just sell the 1%? We're
We
all
can.
1%.
Yeah, yeah,
And doesn't
yeah.
that then fulfill
It does for today. That 1%'s today.
yeah,
3 months from now, that could be a different.
could be
delta.
26%. Yeah.
Yeah,
yes,
right.
Right,
And we didn't do anything today.
right.
The challenge is the market's changed so much
Right.
every day today. So we have to be strategic when she needs to call for that. He may not take it from that 1% you're thinking of.
Yeah,
The 30% policy threshold is not egregious for us to really even focus on,
yeah.
right? But once we extract the 400 from the investment account,
Yeah.
we have to see what the balance of the account looks like at that point. And then we can determine, hey, do we need to make a different change in position? I think, I appreciate the candor up front saying, here's where we are today.
Yeah,
We just need to be strategic as a board when we go month to month now, when we take it out. And the other thing, I think I heard, you visit with us once a year, but I think you guys are in a more frequent cadence of communication. So it's incumbent upon the monthly board meetings, we're maybe reporting out to us to say, I've spoken to Cyril, here's where we are. More so than we have historically, because we're at a $6 million loan portfolio today. Before, we were never that high.
Right.
So we've shifted a lot of asset from the investment side into what I call the production side, we've put it out. We may have to look at our policy relative to big loans, how frequent we're engaging in those loans, and what we want to do with the investment going down the road, right? If we're 30% in equities today, and the equity market hits the floor tomorrow, we have a major decision we have to make. We don't anticipate that, but that's what we have to look at. We're fortunate today, and based on the diversity we have in that, we've got some level of confidence that even if it does take a downturn, we're spread out amongst the risk that we're softly gonna feel that. We won't abruptly feel that. So, and then the flip side of it is when the fixed income stuff starts to come due, kind of how we look at where we're gonna replenish, where we replace that, how we position that going forward. Especially if we want to continue to loan money. That might be our pool initially that we look at.
And the 400,000 we're talking about, is that coming from fixed income, or is it coming from equities? Or is it
The proper way
just
to do
consider our
it,
investment?
yeah, the proper way to do it over time for us to maintain the balance is to cross the board. If I am already pushing on the limits, I should do it across the board.
Well, that's it. I think that's what I'm
Yeah,
trying
exactly,
to say. It
exactly.
sounds like you're.
Yeah, yeah, and the other thing that you guys, I mean, I like what you just mentioned here, that there's a portfolio of $6 million generating 6% a year, so forget early payments, but you got $360,000, if my math is correct here, coming in interest, plus you got $120,000 in this portfolio coming in interest, so you got $480,000 after your carry cost to run the operation. I mean, this is extra money that is sitting there basically to do whatever with, basically. So you do have sources of funds, even if none of these payments get paid up front. And so you have flexibility, but I think for us, if you're comfortable with that, we should stay with the investment policy unless there's something really serious. I think we go to you to get authorization, you run it by the board, but I do not feel that we have anything right now that warrants being outside of the investment policy. I think, you know, you guys spent a ton of time and energy on this thing. I don't want to sit here and second guess what was done. It's been working well. It's doing the job for you. And just to give you an idea, if you go to tab 5, and again, I'm sorry if we're taking too much of your time here. Tab 5, page 10 of 13. I just want to show you one little thing that has been very helpful. I mean, and it's your great, you know, decision to allow us to do this years ago. So again, tab 5, page 10 of 13, this is your equity portfolio, that's about $1.2 million right now. If you look on the bottom line there, unrealized gain and loss in this portfolio, $332,000. You're up in this account $332,000 other than whatever profits were taken in the past. And the projected income is $42,000. So even your equity portfolio has a a concentration towards yield, and it's a 3% basically yield on that. So again, I mean, things are working well. I hate to change things when they're working. I think this, again, the mission of this organization is to lend money. You have, let's say, a $10 million portfolio, 6 of it is being lent, 4 is your reserve fund. I think we're in great shape.
Well, maybe our policy should accommodate those fluctuations that are going to occur within a range or something like that.
Believe it or not, the policy was updated in 2020. It was a lot of work. Time flies. 5 years maybe isn't a bad time to look at maybe the language, if maybe not a total overhaul, but the language in it and see if there's maybe some accommodation.
And as an organization, I think as a board, you guys need to decide, okay, we have 10 million total on the balance sheet. What is the max we're willing to loan? How much do I want to have in reserves? I mean, and that's a good conversation for you.
Yeah, that's
Basically, is because I do remember this account being over 6 million at a certain point. And again, there's nothing wrong in taking the money back, because at that point you did not have loans you were comfortable with. Today, if you're comfortable with your portfolio of loans, that's the mission. I mean, I keep going back to that, but I mean, Watertown needs you for that. And yes, we want to have your reserves and what's the right balance, and that's for you guys to determine and give us guidelines. And it could be added to this policy. Basically, I would call it the loan policy at that point.
Yeah, that might be something to really, we can address over the coming months on that policy. But you bring a good point. I mean, I think we should look at it again, but we gotta look at where ultimately the Cyril's sitting, and we've kind of talked about this preceding this conversation about where we want that loan portfolio, even though it's turning 6% today. And in all honesty, it's really not turning 6%. We just enhanced the rates to 6%. So we have a lot of legacy in there, 5 million or so, I would say, at 5%, which is still a good return. But we want to look at where that portfolio, when we look at all our assets, that's what we should be looking at in policy going forward from here. He made a good point. He remembers when it was 6 million, we didn't feel comfortable putting loans out. Over the last 2 years, we've put a fair amount of loans out, and we depleted this piece of the investment to do it. We may look the next 12, 24 months, and our posture may change about how we're gonna put loans out on the street based on certain economic factors. So, and that's where it becomes critical to have that relationship here, to understand that that piece is turning, and it's turning a pretty good return for where we are today in the environment. I mean, I agree, Steve. I think you raised good points, and something we probably need to look at as we go through the next few months and determine where we want our assets split. How much do we want sitting in an investment account? How much do we want in a loan receivable?
Right, because the only way to balance those percentages is to sell or buy.
Right.
Or the market changes.
Well, and remember one thing. When he talks about he's invested in equities, and we see what the percentage of overall
Right.
single issue is, think of if we have a large loan that goes bad, what's the percentage in our overall loan portfolio?
Right.
It looks a lot different.
Right.
Forget the 6% or the 5% return or the 3.88 or the 4%. It's how's the impact to cash at that point?
And that's the biggest thing for an organization like you. Okay, I'm 10 million, let's say. What is the maximum hit I can afford? Is it $250,000, the size of the loan? Is it, you guys have to figure out, because as you know, I mean, the best way to guarantee that you never take a loss is not to make loans. But, this is where I think, like with us, I can quantify on 400, I know the max will be 40,000 per, and same thing with you guys, you have all this book of business, and somebody comes to you for $1 million, maybe you don't want to take that risk on your own, maybe our limit based on our size is X, and this is what I think you should have policies like that, to reduce risk, I think, and like you say, even if it's 7%, if it's not a good loan, you get paid 12%, I don't know why.
Right.
You don't want to give them enough rope to hang themselves either, so, other questions, concerns for us? Did we confuse everyone enough for today?
Well,
Again, sorry about that, please.
Thank you very much. I always enjoy the board, I think I speak for them, but we always enjoy when you will give a description of our portfolio, and it's always so well considered, and we appreciate that very much.
Thank you, and we appreciate this partnership and anything we can do. I mean, we're more than happy to do it. And if you need us more than once a year, no worries. I mean, we can come in now, we know the place. We'll try to get the right year. But again, I apologize about that. That's not usually how we do business, but this is beautiful anyway. And I went to the old location. When did you move here?
Oh, it's
Almost 2 years?
yeah.
So I wasn't here last year either.
No, that's why these hurried messages, it said a different location, different location.
Okay, so I was not here last
Was there
year.
some presentation last year at the old place?
No, but I think just John came last.
Yeah.
I think, yeah, because it was during, I think you were at the office.
Okay, you know what, you're right, that's right.
Yeah.
It was, yeah, that's okay. No, don't worry.
Okay, I don't know why.
But, before you go though, I will say that I appreciate the offer. We may take him up on that offer based on everything that's happening today. And as he mentioned earlier, how rapidly things are happening today. That between now and October, we could look like a whole different place. So we may
That makes sense.
take that invite later in the year, just because of this change of overall economic approach today. We have no idea, I think we're right, what the tariffs really are gonna do.
And in June is when you have that big payment. If you want like July or August, something like that, it'd be like a mid-year review. If you would like, we could do that
And that might be good,
kind of
because then we can quantify the percentages of where we sit, Steve, against policy. Might not be a bad idea.
It's also a good common sense check, because I heard you say, when things are bad, don't get too excited. When things are good, don't get too excited. And I think we're in that hyper state where, just as a society, so
Yeah.
you've given me a little peace of mind
Yeah,
today.
the best
So I'd
thing
like
you
to
can
talk
do,
with
I
you for a
learned-
little while.
when you have things like that, just sit on your hands, turn the
Good advice.
news off, watch something you like, something funny, or go for a walk. This is, this is the way to do it. Let us worry about this stuff. But at the end of the day, I mean, all of this can be very good, but it's unnerving when you're going through it. And you can make bad decisions if you do any knee-jerk reactions, which our job is to make sure we don't do any of that for you. So, again, thank you for the time, and thank you for the partnership, and if you want us here, just let us know, July, August, whatever. At least one of us will be here, and now we have no excuse, one of us has not an excuse not to find a place.
Kylie, could I just grab a quick signature for the form?
Okay.
Oh, that's us.
Do we need a motion to accept?
Let's just do it
Let's
just
do
in
it.
case.
Thank you very much.
I don't know.
Can,
Peggy would know this, I don't know.
can I get a motion to accept the RBC Wealth Management Annual Investment Update?
So move.
Second, Steve. Any further discussion? All in favor?
Thank you.
Any opposed?
Thank
Thank you
you.
very much. That's great. Okay, so we left off there at the consumer loan report. Did we do the loan report?
Yeah, so,
Okay.
We're gonna do the loan review.
Loan
the laundry
review.
committee.
Okay. Who's gonna discuss the loan review?
Yeah.
That's you.
Why don't you just keep going, Mark? I don't really stop now.
I don't really want to.
We just really want you to talk today.
Goodness, that's not great.
Why? You're doing a good job.
I'm barely holding it together.
We're trying to take your mind off it. There you go.
Yeah. What do we got here? Loan Review Committee convened, oh, this is part of the minutes.
Yeah,
Where are we?
we're on this, you're on the expert properties LLC, the request for $128,000.
Okay. All right. So we had a meeting to discuss Expert Properties LLC, their application for $128,000 at 20 years, 6% fixed. The committee convened, discussed this, and pushed it to the board for approval. I'd like to open up the floor for any discussions on this.
I'll just say, this was a request for the purchase of a building on 1543 State Street for these folks to locate their business operation into. I think currently they're outside the city. And we're gonna participate in a deal with Watertown Savings Bank, who'll be the lead lender at 50% level. We'll play a 40% level, and then obviously the borrower, Expert Properties, will be putting 10% of their equity in. And it will move their business operations into the city of Watertown. They'll run they run a glass company out of it. And memory serves me, they were gonna create, was it 2 jobs in the
Yep, so, yeah.
first year? 2 jobs in the first year of operation. So, that's really what the oversight was. I mean, other than that, I think as we talked in committee, it was a good opportunity to bring this business into the city of Watertown and, locate their operations here.
I know we talked, yesterday, so about the zoning, so 80% of what they do is on the road. There is no automotive. He said that's where sometimes people get confused. With what they do is they do sometimes repair glass there, but 80% is on the road, and then 20% is what they do in the shop, but when it's in the shop, it's like picture frames, stuff like that. It's nothing, he did say he called, and they said it was zoned correctly for what he's looking for. I spoke to him this morning, so.
Called today or?
Yeah, I called, we talked yesterday, but then he followed up this morning with his KPI is 80% on the road, 20%.
Was there a zoning issue up there? Is that what it was?
Just, I think the use is allowed, it's just whether a special use might be required if he was doing automotive repair at that location.
Okay, and he said, yeah, he said where they sometimes people get confused with his business, is there is absolutely no, there is some glass, but there is absolutely.
Well, he doesn't do any
no
auto
automotive,
repair, he would just be doing glass
Just
service.
glass.
Yeah. It might be on an automobile, but yeah, is that called auto repair?
Probably would meet the definition of repairing the windshield, but, you know, in general terms, but most of that or all of that is off-site.
Yeah, because
Comes
that's
to your
usually,
driveway to repair your
yeah,
cracked windshield or whatever.
Yeah.
He still needs to get in touch with us about,
the zoning plan.
the zoning compliance. Just-
Okay. I'll let him know when I talk to him today.
Is there anything that would prevent us from moving forward with this approval? Great.
No, we could approve this loan, yes, you'd have to.
That's it, that problem. Does, any further discussion on this? Can I get a motion for approval? Second?
Second.
Okay. Any further discussion? All in favor?
Aye.
Any opposed? Motion is carried. Moving down to the CEO report.
So this month, okay, the people I've spoken with, the meetings we've attended, but as far as our social media, I know it's always, that is one of our focuses. We did do another giveaway with Sweet Hello Bridal, and I do see that our collaborations with these businesses has strengthened our relationship. From just talking, I mean, I feel like now we talk to Katie almost on a daily basis, so it's definitely doing what I wanted it to do. This last month, a lot of it was based around the audit, which went really well. Our past due loans, I do feel that that is, I think we decreased our past due loans on this report. I think it was by 2 or 3. So we are making progress there too. Does anyone have any questions?
Can I get a motion to accept the CEO report?
I'll move it.
Second, Steve. Any further discussion? All in favor?
Aye.
Any opposed? We'll move.
Thank you for
Thank you
adding
very-
that to the agenda, I think that's really good.
Yeah. Any old business?
Not on business, just something that I thought of as Cyril was talking and Mike made about. The property at Randuzzi Street, I think it's a company that owns that building, it's operated out there, Sandy LLC, am I correct?
Yes.
So the city is interested in purchasing that, has agreed to purchase that property from the owner. Yeah, and so we're talking about an influx of cash.
So that is a potential one.
That is potential, and it looks like the principal balance
That's
is 200.
220, that's good.
That may be helpful.
Maybe that's because he did ask me about the payoff like last month, and then I hadn't heard from him, so. Okay.
That'll be nice.
Is there an anticipated time frame on that? or?
Not that I know, I'm sure there is a, not that I know of.
So we might
Council
share,
approved
because
it.
that could help,
Yeah.
your need on his, equities. Yeah, it's nice to hear, Mike.
Council approved it, 2 weeks ago.
Okay, so,
I imagine in the next month or two, we'll
Okay.
potentially be closing.
Sometime it's still in there, that's the way it is.
Okay. I would like to just say one thing here. I know how stressful the audit period is and how well this seemed to go. Under the CFO of Joy Newfer and Kylie's leadership, I think this was a really great meeting, and just wanted to let the record reflect that.
Thank you.
thank you. Yes, thank you, ladies.
Can I get a motion to adjourn?
I'll make the motion to adjourn.
Second.
All in favor?
All
You
in
can
favor?
second it if you want.
We are adjourned.